Hey guys, it is Julie here with TipRanks. Today we're taking a look at a few dividend stocks that analysts have unanimously rated a buy. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're talking dividend stocks because who doesn't love that passive dividend income? And today we're focusing on 3 different companies that all come in with unanimous buy ratings from Wall Street analysts. So we're going to take a look at these companies, what it is that they do, what kind of dividend they're paying, and what those analysts are predicting for the stock's future. Of course, I found today's stocks using the TipRanks Stock Screener. Found under Research Tools on the TipRanks website, I set my search for dividend stocks with a high to very high yield, an outperform score on the TipRanks Smart Score, and a strong buy consensus from analysts, as well as trading on the major exchanges. And I got my list down below. And don't forget, you can also download the TipRanks mobile app if you want to access some of your favorite investment tools on the go. Links will be in the description down below. Now, the first strong buy dividend stock that caught my eye was Agnico Eagle Mines. Their stock trades under the ticker AEM, currently priced at $49.38 per share. They have seen growth of 24% in this past year, and they have cooled off a bit in the last 6 months, down 1%, gaining back a couple in the last 3. They do score an 8 out of 10 on the TipRanks Smart Score, with some bullish blogger sentiment and insiders scooping up over $400,000 worth of shares lately. Agnico Eagle Mines deals in the production and exploration of gold. Founded back in 1957, they are a senior Canadian gold mining company producing precious metals from operations in Canada, Australia, Finland, and Mexico. They have a pipeline of high-quality exploration and development projects in these countries, as well as the United States and Colombia. The company has paid a dividend every single year since 1983. And their current quarterly dividend comes in at 39 cents per share for a current dividend yield of 3.29%, and that is well ahead of their sector average of 1.87%. They just passed their last payment date on September 14th. Near the end of July, Agnico Eagle did share their Q2 quarterly results. They came out with an earnings beat and saw record quarterly gold production. They reported quarterly revenues of $1.71 billion, and earnings per share of 64 cents came in 10 cents ahead of analysts' expectations. Their president noted that they delivered another strong operational quarter with record quarterly gold production and better than expected costs driving solid financial results. With this excellent start to the year, they're tracking very well to meet their annual production and cost guidance. Their stock comes in as a unanimous strong buy with 8 current ratings. The average price target for the company comes in at $62.67. That would be an upside potential of nearly 27% from current prices. Down below, we can see those recent ratings, a lot of them coming a couple months ago following that earnings report. We do have a low-end price target with a buy rating and 0.5% upside. A bit more recently from last month, a high-end price target with upside of over 43%. Second on our list today, we have Sun Life Financial. Their stock trades under the ticker SLF and is currently priced just above $50 per share. They've seen growth of 23.5% in this past year, including growth of nearly 15% in the last 6 months. Sun Life is a Canadian financial services company and is one of the world's largest insurers. The company provides life and health insurance, as well as wealth and asset management solutions to individuals and corporate clients globally. With about 85 million clients, they have offices across 28 different markets, over 97,000 advisors, and $1.37 trillion in assets under management. Sun Life has been paying their dividend for about 23 years now, and their current quarterly dividend is 55 cents per share for a dividend yield of 4.33%, once again coming in well ahead of their sector average of 2.1%. They shared their Q2 results on August 8th, where they did come out with an earnings beat. Revenue of $5.73 billion did fall a little bit from the previous quarter and year over year, but on earnings per share, they came in at $1.16, 3 cents ahead of analysts' expectations. Their president and CEO noted that they delivered good second quarter results as their diversified set of businesses continued to demonstrate resilience in a challenging economic environment. They were also pleased to announce that they're going to acquire Dialogue Health Technologies, which is Canada's leading integrated health platform that provides access to affordable, on-demand quality care. Following this, they did have 6 Wall Street analysts reiterate their buy rating on the Sun Life stock. And their average price target comes in at $56.32, which would be a growth potential of 11.4% for this next year. Down below, we can see a list of those ratings, all fairly close in price target, ranging from 9.5% to 15.5% upside. And third on our list, we are looking at an American company with Phillip Morris. Their stock trades under the ticker PM, currently priced at $96.72 per share. Now, they have seen some ups and downs with some big growth back here, and overall are up 6% in the past year, including 3% in the last 6 months. Their stock does score a 10 out of 10 on the TipRanks Smart Score, with positive news sentiment and increased hedge fund activity. Phillip Morris, of course, is a big name in the tobacco industry. They manufacture and sell cigarettes, tobacco, and nicotine-containing products. Of course, their smoke-free products and related electronic devices are the latest craze. In fact, this tobacco company is working towards a smoke-free future. In 2022, almost 35% of their total net revenues came from their smoke-free products, and their target is to increase that to at least 50% by 2025. Phillip Morris has paid and increased their dividend every single year since they became a public company back in 2008. Their current quarterly dividend is $1.27 per share for an impressive dividend yield of 5.3%, well ahead their sector average of 2.12%. And once again, we did see another earnings beat when they reported their latest quarter near the end of July. Their reported net revenues increased by 19% to $8.94 billion, and they reported earnings per share of $1.60, outpacing analysts' expectations by 10 cents per share. Their management noted their strong business momentum continued with their excellent second quarter, and that their strong fundamentals gave them further confidence as they enter the second half of the year, and that they were raising their full year 2023 forecast for organic net revenue growth. And of course, analysts love an increased future outlook, and their stock currently has 7 buy ratings. Their Unanimous strong buy does come with a price target of $116, which would be an upside potential of over 20% for this next year. Down below, looking at our detailed list of ratings, on the low end, we have an upside of 14% and a high-end price target of 26%. Not a big gap in price targets down here. So there we have 3 dividend stocks, all with unanimous buy ratings from Wall Street analysts. Let me know your thoughts on these companies in the comments down below. I always love hearing from you guys. And please remember that these videos are never a suggestion to buy or sell any specific stock, just providing some insight and entertainment. So please make sure you're always doing your own research and due diligence and sticking to your own investment plan. Thank you guys so much for watching. Have a great day, and I'll see you back here next time.